I want you to picture a scene from the late 90s. It's a humid summer day, we're out on a golf course, and there's this teenager, let's call him Brian.
Okay, setting the scene.
Yeah, and he is just sweating through his polo shirt. He's lugging this massive, heavy bag of clubs for a few dollars an hour. You know, he's a caddy.
Oh, man, a rough summer job.
Right, and suddenly, a guy walks out of the clubhouse just beaming. He looks at his playing partners and shouts, "You are not going to believe this. The Dow is up 300 points."
Well, that sounds like a very good day for the golfer, but I'm guessing a confusing one for the caddy.
It was a total party. High fives, cigars, people shouting about how amazing it is. But the teenager, he is just standing there holding the bag, completely lost.
Yeah.
He knew Dow Jones was a phrase people said on the news, and he knew up meant good. But beyond that, he had zero clue why these adults were celebrating.
I mean, that tracks.
And here is the kicker. That teenager was Brian Feroldi, the author of the source material we are covering today. And honestly, I think that teenager is still most of us.
I think you're right. It's a very common experience. We are bombarded with these terms constantly. Dow Jones, bear market, IPO, PE ratio. They're in the news, on our phones, in casual conversation.
Exactly.
But if you actually hit the pause button and ask someone, okay, but why? Mechanically, why did the market go up today? Very few people, even people with hefty retirement accounts, can give you a straight answer.
It totally feels like a black box. You put money in, you cross your fingers, and you just hope it comes out multiplied.
Right.
So our mission for this deep dive is to break that box open. We are looking at Feroldi's book, Why Does the Stock Market Go Up? We're going to strip away the jargon and look at the market not as a casino, but as a logical, mechanical system.
And it really is logical. That's the most important takeaway here. It's not magic, and it's not just gambling. It's a machine.
Yes.
And understanding how that machine works is crucial because, as Feroldi puts it, the stock market is the greatest wealth creation machine of all time.
I love a bold claim like that. The greatest wealth creation machine. But hearing that can also trigger a skepticism alarm. It sounds like a late-night infomercial, right?
Oh, absolutely.
We need to prove it. So before we get into the mechanics of tickers and trades, walk us through the story of Aaron.
Right, the story of Aaron. Now, Aaron is a fictional proxy used in the source, but the math behind his story is very real, and it illustrates perfectly how this machine functions for a regular person.
Okay.
So Aaron starts his career in 1981.
Which is a pretty significant year.
Very significant. That is essentially the birth year of the modern 401k. So Aaron's making $26,000 a year. He is not a Wall Street wolf. He's a regular guy.
Just normal salary.
Exactly. He's not a financial wizard. But he makes one critical decision. He decides to put $400 a month into an S&P 500 index fund in his 401k.
Okay, so $400 a month, that's a car payment for some people. It's significant, but it's not millions.
Exactly. But the key isn't just the money, it's the behavior. He does this every single month. When the market crashes in '87,
it keeps going.
He keeps contributing. The dot-com bubble bursts in 2000, he keeps contributing. The great financial crisis in 2008, he doesn't touch it.
Wow.
He just lets that $400 a month ride for 39 years.
He is basically the master of doing nothing.
Precisely. He's lazy in the best possible way. Fast forward to 2020. Aaron is ready to retire. He looks at his account balance.
And what's the number?
It's staggering. It's over $3 million.
Just from $400 a month?
$3,013,537 to be exact. That is the aha moment.
Yeah, because if you do the math on that, $400 a month for 39 years is only roughly $191,000 of his own money.
Exactly. He put in less than 200 grand. The market provided the other 2.8 million.
That ratio is insane. The market generated 15 times more wealth than he actually saved.
That is the power of compounding at the market's historical average of roughly 11% per year. And here is a detail from the book that really blew my mind.
What's that?
In the later years of his career, the market gains were adding more value to his portfolio in a single year than he had contributed in cash over his entire life.
See, that is the dream. Your money working harder than you do.
Yep.
And I think it's important to mention to everyone listening right now, if you have a retirement account, a 403b, an IRA, or a pension, you are already strapped into this machine.
You are. You're a participant.
So you might as well understand the engine.
Absolutely.
Let's pop the hood then. We need to define what a stock actually is, because I think we get so caught up in the digital numbers blinking on a screen that we forget the reality.
Right.
To do this, the author uses a great example, the best coffee company.
Let's strip away all the Wall Street complexity.
Okay.
Imagine three friends, Natalie, Ethan, and Lauren. They want to open a coffee shop in their neighborhood. They run the numbers and realize it costs $10,000 to buy the espresso machine, the beans, the lease, everything to get started.
Simple enough startup costs?
But they don't have equal cash. Natalie puts in $6,000, Ethan puts in $3,000, and Lauren puts in $1,000.
Making up the 10 grand.
Right. And because they put up the money, they own the business. In financial terms, they own the equity or the stock.
And this is strictly proportional, right?
Exactly. Natalie put in 60% of the risk capital, so she owns 60% of the stock. A stock is just a legal claim to a portion of a business. It's not a lottery ticket, it's a property right.
But here's a question I think a lot of skeptics have. Why is that piece of paper, or these days, that digital entry, worth anything at all?
That's the million-dollar question.
If I buy a stock, I can't walk into the headquarters and take a chair. Why would anyone pay me for it?
Because of the earnings, the profits. This is the anchor of the whole system. Let's say the best coffee company has a great year. They sell a lot of lattes, pay their rent, pay their baristas, and they have $5,000 left over in pure profit. The owners have a choice.
What can they do with it?
They can keep that money in the business to paint the walls or buy a second machine, or they can pay it out to themselves.
And if they pay it out, that's what we call a dividend.
Correct. So in this case, let's say there are 10,000 shares total. That $5,000 profit represents 50 cents of profit for every single share.
Nice.
Even if they don't pay it out today, that 50 cents legally belongs to the shareholder.
So that is the fundamental anchor of value. If you own a stock, you have a legal claim on the future cash flows of that company.
Yes. If the company makes money, you make money. That is why stocks have value. It's not just speculation, it's a claim on cash flow. And this is where the market comes in.
Right, because Natalie, Ethan, and Lauren might not want to own this coffee shop forever. Or maybe they just want to sell a little bit of it to buy a car.
They need a place to sell it.
Exactly. And the source material does a great job of demystifying the stock market itself. We have this image of guys in suits screaming on a trading floor or supercomputers flashing in a dark room.
But it started much simpler than that.
It goes back to a tree, right?
It does. 1792. New York City. A group of 24 brokers met under a buttonwood tree on Wall Street.
Literally just outside under a tree.
Just standing there. They just needed a consistent place to meet up and trade shares of businesses and government bonds. They signed the Buttonwood Agreement, which basically said, we will only trade with each other, and here are the commission rates.
So it's literally a farmer's market.
That is the best possible analogy. A stock market is just a farmer's market for buying and selling partial ownership in companies. Instead of trading cash for tomatoes or corn, you're trading cash for equity.
Right.
The New York Stock Exchange is just a highly regulated, high-speed farmer's market.
Okay, so we're at the farmer's market. We're looking at the prices. But on the news, we don't usually hear best coffee company is up. We hear the Dow is up or the S&P is down.
The scoreboards.
Exactly. These are the scoreboards. But the book makes a really interesting point here. These scoreboards aren't created equal.
No, they really aren't. And this is where a lot of people get tripped up. Let's start with the Dow Jones Industrial Average.
The famous one.
It's the celebrity of the group. It's the one your grandfather talks about. It was created by Charles Dow in 1896. He basically just wanted a quick way to tell newspaper readers if the industrial economy had a good day.
But you have a bit of a beef with the Dow, don't you? Or at least the financial experts do.
Well, it's functionally flawed. The Dow is what we call price-weighted. It tracks 30 prominent companies, but the math gives more influence to the companies with a higher share price.
Break that down for us. Why is that a problem?
All right, think about a pizza. If I cut a pizza into 4 slices, each slice is huge. If I cut it into 100 slices, each slice is tiny. But it's the exact same amount of pizza, right? The share price is just how many slices the company is cut into.
Oh, I see.
The Dow ignores the size of the whole pizza and only looks at the size of the slice. Look at McDonald's and Intel.
Okay, what happened with them?
In October 2020, McDonald's stock cost about $228 per share. Intel was about $54.
So McDonald's was a lot more expensive per share.
Right. Because McDonald's price was 4 times higher, the Dow's math gave McDonald's 4 times more influence over the entire index.
But wait, isn't Intel a massive company?
That's the thing. At the time, Intel was actually a larger company than McDonald's by about $52 billion in total value.
Wow.
But because the Dow focuses on the arbitrary price of a single share, it ignored the actual size of the company. It makes absolutely no mathematical sense in the modern world.
That seems incredibly outdated. So when the news screams the Dow is down, it might just mean that a few companies with high share prices are having a bad day, not the whole economy.
Exactly.
Yeah.
That's why professionals prefer the S&P 500. It tracks 500 companies, not 30, and it uses market cap weighting.
Market cap, meaning the total value of the company, the whole pizza.
Yes. Market cap is the share price multiplied by the number of shares. So Apple and Amazon have the most influence in the S&P 500 because they are the most valuable companies in America, regardless of what one single share costs.
It's a much more accurate representation of the economy then.
Vastly more accurate.
And then briefly, we have the NASDAQ.
Right. Created in 1971. It was the first electronic exchange. No physical floor, just computers connecting buyers and sellers.
So it attracted a different crowd.
Exactly. Because it was high-tech. It attracted high-tech companies. Microsoft, Intel, Adobe. So when you hear the NASDAQ is down, it essentially serves as a shorthand for tech is having a bad day.
Okay, so we have our scoreboards. Now let's talk about how a company actually gets onto the scoreboard. We constantly hear about the IPO, the initial public offering.
The big debut.
Right. Let's go back to the best coffee company. Why would Natalie and her friends want to deal with the headache of going public? Why bring thousands of strangers into their business?
Growth. Pure and simple. Let's say this coffee company is a huge hit. There are lines around the block.
They're crushing it.
They are. And they want to build 10 more stores across the city. That costs money. Maybe $100,000.
They could just go to a bank for that.
They could,
Right.
but banks charge interest. And you have to pay it back every month whether you sell coffee or not. That adds a lot of risk to the business.
Sure.
Or they can sell more stock.
So they create new slices of the pizza and sell them to the public.
Exactly. This is the IPO. They sell a chunk of the company to strangers to raise that $100,000 in cash to build the new stores.
Yeah.
Now, there is a catch. It's called dilution.
Dilution. That sounds negative. Like watering down a good drink.
It feels that way at first. Natalie used to own 60% of the company. But after they issue all these new shares to the public to raise the cash, maybe she only owns 30%. Her percentage of the pie got smaller.
But the pie itself got bigger.
Hopefully.
Yeah.
That is the fundamental trade-off. She owns a smaller percentage, but now it's a percentage of a much larger, faster-growing company because they have that $100,000 to expand.
There is a really important distinction here that the author makes, and I think it's one of the biggest misconceptions out there.
Which one?
Once the IPO is over, let's say I open my brokerage app today, right now, and I buy a share of the best coffee company. Does the coffee company get my money?
No, they do not.
Not at all.
Not a cent. And this is crucial to understand. This is the secondary market. Think of it like a used car.
Okay.
If Ford sells a new car to a dealership, Ford gets paid. That's the IPO. But if you buy that Ford 3 years later from your neighbor, Ford doesn't see a dime of that transaction.
Oh, that makes perfect sense. So when I'm trading on the app, I'm just swapping ownership claims with other investors.
Exactly. The company only gets paid during the IPO, or if they decide to issue more new shares later. The rest of the time, the stock market is just us trading these claims amongst ourselves.
That is a massive mental shift. I think many people assume that if they buy Apple stock, they are funding Tim Cook's next project directly.
Right, they think it's like a Kickstarter.
Yeah. But really, they are just buying a seat at the table from someone else leaving the table.
Perfectly put.
Okay, so if we are trading these claims amongst ourselves, how on earth do we know what the price should be? How do I know if $10 is a bargain or a ripoff for a share of best coffee?
This brings us to the holy grail of investing metrics. The PE ratio, the price-to-earnings ratio.
I feel like people's eyes glaze over here because it sounds like algebra, but the concept is actually super intuitive.
It really is. It's just the price of the share divided by the profit or earnings per share.
Let's keep it simple.
Lay it on us. Say Best Coffee earns $1 of profit for every share that exists. If you pay $10 for that share, the PE ratio is 10.
Which essentially means, at the current rate, it will take 10 years for the company to earn back the money I just paid.
Right. It's a payback period.
Yeah.
Now, imagine if the price was $1,000 for that same share.
Yeah.
You pay $1,000 to get access to $1 of earnings a year. That's a PE of 1,000. It would take a millennium to earn your money back.
That sounds terrible.
It is. That's a 0.1% return.
Yeah.
You would literally be better off putting your money under your mattress.
So generally speaking, a lower PE is better. We want to pay less for those earnings.
Generally, yes. That means the stock is cheaper. But, and here is where it gets nuanced, sometimes it makes sense to pay a high PE.
This is the donut example from the source.
The donut example, yes.
Yeah.
Suppose Best Coffee announces, hey, we aren't just selling coffee anymore. We have a secret recipe for donuts that cost us almost nothing to make but sell for $5. We think this will double our profits next year.
Suddenly, that $1 earning stream might turn into $2 or $3.
Exactly. Investors look at that potential growth and say, I will pay more today because I know the earnings will be higher tomorrow.
So they bid the price up?
Yes. So maybe the PE goes up to 20 or 30. Investors are paying a premium for growth.
So valuation isn't static. It's this constant balancing act between what the company earns now and what we think it will earn later.
Correct. And that balancing act is what causes the price to move every single day.
Which leads us to the big question, the title of a book. Why does the stock market go up? And conversely, why does it crash? Because sometimes it feels incredibly random.
Like a mood ring.
Exactly like a mood ring.
In the short term, it is a mood ring. The author uses a famous concept from Benjamin Graham. He says the market is a voting machine in the short term and a weighing machine in the long term.
Unpack the voting machine for us.
In the short term, day to day, week to week, the market is driven by popularity, sentiment, fear, and greed. It's an auction house of human emotion.
The Starbucks examples in the book were great for this.
They are perfect. Take November 12, 2020. Starbucks stock fell.
Did something bad happen?
No news. Nothing happened at the company. They didn't burn down a store. They didn't lose a lawsuit. Investors just felt a little pessimistic that day.
And then the next day?
November 13th, it went up. Again, no news. The mood just shifted. But then look at real news. March 2020.
COVID shutdowns.
Exactly. Fear takes over. The stock plummets. Why? Because investors were voting that the future looked bleak.
And then contrast that with the pumpkin spice latte announcement.
Yes. August 2020, they announced the pumpkin spice latte is returning early. Optimism, greed. The stock jumps.
Just for a drink.
Right. In the short term, the price isn't checking the accounting books. It's checking the pulse of the investors.
So that's the short term, the voting machine. But you can't build a retirement on a mood ring. That sounds terrifying.
No, you can't. That is why we look at the long term. In the long term, the market becomes a weighing machine. It weighs the actual results.
The earnings.
The earnings. If Best Coffee Company successfully expands from 1 store to 10 stores and their profits go from $20,000 to $200,000, the stock price will go up. It has to.
Why does it, quote unquote, have to?
Because of the PE ratio we just talked about.
Mm-hmm.
If the profits go up to $200,000 and the stock price stays low, the PE ratio would drop to like 1 or 2.
It would be insanely cheap.
It would be the bargain of the century. Investors would realize, wait, I can buy this huge stream of cash for pennies. They would rush in to buy it, and that demand drives the price back up.
So, simply put, stock prices follow earnings.
Over the long term, yes, 100%.
Yeah.
If companies make more money, their stock prices rise. If they make less, prices fall.
Everything else is just noise.
All the daily noise, the election news, the weather, the pumpkin spice lattes, it all cancels out eventually. What's left is the cold, hard cash flow.
And that brings us right back to Aaron, our millionaire from the beginning. He didn't get rich because he guessed which way the mood ring would turn on a Tuesday.
No. He didn't care about the mood ring at all.
He just stayed consistent.
He got rich because he made a bet that over 39 years, American companies would figure out how to make more money. He bet that they would sell more coffee, build better computers, ship more packages. And he was right.
It's incredibly empowering when you view it that way. It's not a casino. It's a partnership with the economy.
It really is. You are providing capital to companies, even if it's via the secondary market. You are supporting the valuation that allows them to borrow and grow, and in exchange, they are sharing their profits with you.
So let's recap what we've learned today. We have unpacked a lot of material.
We have. We established that a stock isn't a lottery ticket. It's an ownership stake in a real business. We learned that the market is just a venue, a farmer's market, where we trade those stakes.
We learned that the scoreboards like the Dow have some serious quirks. I mean, price weighting is bizarre, and that buying stock on an app is a trade between people, not a direct donation to the company.
And most importantly, we learned that while the daily price is driven by how people feel the voting machine, The long-term wealth comes from what companies earn the weighing machine.
Which leads me to a final thought I want to leave you with. We have been talking about numbers and profits and earnings all day. But where do earnings actually come from? Why do companies earn more money in 2020 than they did in 1980?
Innovation, productivity, solving problems.
Exactly. Earnings go up because companies solve problems. They invent the smartphone, they brew better coffee, they figure out how to deliver packages faster.
Progress.
Yes. So when you invest in the stock market, you aren't just betting on red or black. You're essentially making a bet on human ingenuity.
I like that.
You are betting that 20 years from now, humans will be better at solving problems and creating value than they are today.
And historically speaking, betting on human progress has been the smartest bet you can possibly make.
I couldn't agree more. Thanks for taking this deep dive with us today. We hope you feel a little less like that confused caddy holding the bag and a little more like the guy shouting about the Dow.
Happy investing!
See you next time.